Hey, how's everybody from BiggerPockets doing? Dave Van Horn here, President and CEO of PPR Note Company, coming at you today from chilly Philly. It's getting a little brisk out here. I don't know how everybody's doing. Maybe you guys can let me know if you can hear me, you can see me. Let me know where you're chiming in from. I'll be checking my screen for some, hopefully, some favorable comments and some good questions. Um, Speaking of which, if for some reason I don't get to your question today, I do try to answer everybody I can. But if for some reason I can't get to your question, we do have a free Note Investor Q&A coming up on November 19th at 8 p.m. Eastern Time. And on that call, we get into every kind of note question under the sun. All you have to do is go to my website to register, pprnoteco.com, and you can register for that Q&A. So if for some reason I don't get around to answering your question today, we pretty much cover, usually we have a topic and then we cover any kind of deal question, usually deal specific at first, and then we open it up to general questions. But today I plan on covering, well, obviously this is how to get started investing in real estate notes, and it's kind of like a real estate investing, note investing 101 course. Basically, how do you get started? And some of the topics I'm going to be covering today would be, why should you invest in notes, right? And I think that's a pretty easy question, right? It's no tenants, no toilets, no taxes, no inspectors or townships. And more importantly, no contractors. And you know what they say about contractors, because I used to be one of them, is that they're worse than the tenants, right? So plenty of good reasons to invest in notes. Also wanted to talk a little bit about what is a note, because that question comes up a lot. And I know, I listen to my wife thinks a note's a musical symbol, right? And it probably wasn't that long ago that I thought a loan meant to be all by myself, right? But all kidding aside, a note is a promise to pay. And usually when we're referencing a note, we're usually talking about a note and a mortgage that's tied to a piece of real estate. Now, another thing I often mention is, that we're all in the note business. So why do I say that? Why do I say that we're all in the note business? And it's really because it's in everything we do, especially there's so much debt, especially in the U.S., right? There's, student loan debt, mortgage debt, auto debt, medical debt, and the list goes on and on, credit card debt. So a lot of times I introduce the concept to people this way by saying that we're all in the note business, but most of us aren't paying attention to us. Most of us are just writing a check to the bank or to the lender, and we don't really think too much about, hey, what would it be like to receive the check? Or what would it be like to invest in debt at a discount? Like, that never occurs to us in a lot of cases. But even, the hard money lenders, right? They're in the note business, right? They're in a short-term secured commercial note for rehabbers, right? So a lot of us are in the note business. We just don't even realize it sometimes. We just go through life not even thinking about it. And really, I'm just trying to introduce that idea to people that we're kind of all in the note business. But today's real topic is going to be about which is better. Which should you do, especially in a passive sense? Should you be a passive note investor or a fund investor? So, that's kind of what I wanted to talk about today. So, hopefully you guys can hear me okay, see me okay. I see some folks coming in from Pennsylvania, New York, California, the Bay Area. Rosanna, what's happening? And Jack, you guys seem to be doing good tonight. Thanks for joining me. And by all means, make some comments, ask some questions. If there's something you want me to cover or cover on a future Facebook Live, more than happy to do that. So I know last time that I was on a Facebook Live on BiggerPockets, we talked about, do you need an entity or an LLC to do the note business? And you can kind of ask that question about real estate in general, right? When do you need, well, part of it is when do you need that entity? And so by all means, go out on YouTube or on Facebook, and you can probably search that down and on that previous call. But really, the short answer is it depends. Do you need an entity and when? And it kind of depends on what your goals are, your purpose is, your risk tolerance. But it definitely makes you more professional looking and definitely more serious, especially to note sellers. So, if you're an entity and you're, trying to buy notes from somebody, there are note sellers who do require that you be an LLC or an entity. They don't really want to sell to individuals. And I think it's because it makes it look, it's more professional looking, that type of thing. So if you want to dial up your business, by all means, think about getting that. But back to today's topic, which should you do, passive note investing or fund investing? I think the short answer for me is, a lot of people say, well, which one's better? And to be quite honest, I don't know that I figured that out yet, and that's probably why I do both. But I think, why does that happen? And I think it's, first of all, not everybody's cut out to work, non-performing notes, for example. It's definitely a more active role if you're working in the non-performing note space. And I know I've done them all. I've done both. I've been an asset manager before. And it's not for everybody. It takes a certain skill set. It takes a certain level of commitment. Definitely takes more time to learn that. So it's not a case where I'm saying don't do that. But you definitely have a much more active role with borrowers and attorneys. Definitely a lot more skill set required. There's a lot of compliance these days. So you want to be aware of compliance. Actually, we're going to be covering that on our Note Investor Q&A on November 19th at 8 p.m. Eastern. I actually have a compliance officer on that call who's going to discuss a lot of that regulatory environment, the licensing requirements, those types of things to watch out for to play it safe in the business because it is important. But some of us are more passive, myself included. I don't really buy non-performing notes to work on a personal level or anything. That's not my thing. I'm more of a passive guy. So if you're someone that's has a limited amount of time to deploy into the note business, then you're like me, right? And now it's a question of, do I invest in a note fund or do I invest in the actual mortgages, right? So let's talk about the note fund first, right? So to me, well, first of all, before you even get started, you do want to know what type of investor are you, right? Are you active or passive? Obviously, that's one. And then how much capital do you have to deploy? Those types of things kind of dictate a little bit what you get involved with. But there are, I like to think about 3 different types of funds that people can invest in. One is obviously a fund that only accepts accredited high net worth investors, right? And the short definition of that is someone who makes $200,000 a year if they're single. You can make up to $300,000 as a couple, or you would have $1 million in net assets, not counting your primary residence. So not too many people fit that bill. In fact, it's about 4% of U.S. households. So it might sound like a lot of money to you. It might not sound like a lot of money to you. But you know what? The IRS has stats on that, and that's where that comes from. So only 4% of households in the U.S. meet those requirements. And so some funds, they require that you are high net worth. Then there's another type of fund that allows up to 35 sophisticated investors where you just have to be knowledgeable in that asset class that you're investing in. And in this case, that would be real estate-backed notes, for example. So there are some funds that are out there that do that. I know there's some on BiggerPockets. I have some friends that do that, where they allow up to 35 sophisticated investors who are not necessarily high net worth. Now, if you're an entity trying to invest in one of these funds, the amount of assets is significantly higher. You might have to have as much as $5 million in assets, unless you were like a single person LLC or something. Then it would relate back to your net worth or your income. But so the third type, let me see. Oh, one other distinction on the 35 sophisticated investor type of fund is usually they're not allowed to generally solicit. So they're not allowed to market anywhere publicly. But there's on the accredited investor type funds, the accredited only investor type funds. Some of them can generally solicit and do regular marketing, whether that's on social media or wherever in public. They can actually solicit investors that way. Now, the third type of fund is more of the crowdfunding funds, sort of like you'll see Prosper.com or Lending Club, or in fact, there's even a note fund called AHP. They do crowdfunding where investors can invest small amounts into pools of mortgages, and it's a way for smaller investors to get involved, and they just pull a lot of little investors' money together. It's definitely a lot more robust. There's a lot more people they're dealing with. Some of them, it's some of those types of systems, it's hard to talk to a person. I'm sure if I reach out to Lending Club, it might be hard to talk to a live person where they're dealing with so much volume, that type of thing. So there's crowdfunding type sites, or they call them a Reg A fund as well. That's where they're allowed to crowdfund up to 20 million or 50 million, depending on the fund, and they do accept smaller amounts from folks who are not high net worth. So that's probably the three types of fund investing that I can think of. There are, when you're investing in a fund, just keep in mind you're investing in that management team. You're also investing in shares of an LLC. So I like to describe it as investing in shares of a non-publicly traded company is probably a good way to look at that, right? But you definitely have less responsibility when you invest in a fund. There's less accountability, obviously, and responsibility. And most importantly, there's less liability. So that's one of the things high net worth investors enjoy about investing in these private placements and into these note funds or even real estate funds, is that they're limited in their liability. Their overall exposure is really just their actual investment. They can't be sued above and beyond their investment in that asset. So it's true mailbox money is what I like to call it. So there's definitely some advantages to the fund investing, right? One is, it gives you buying power, right? You're pulling money together. You're able to get an economy of scale going. You can buy more assets in the note space. It's a capital intensive business. It's a cash business. There's usually not leverage there unless you're buying $100 million a month from Goldman or something, where they might finance some of that. Most of the investors that I'm probably talking to right now, that's not the case. So you're going to get more buying power by pulling your money together, and you're not really able to leverage. It's not like you can go to a bank and you're buying, an apartment complex. And the apartment complex, I can go get a commercial mortgage for 70% or so, and then we only have to raise 30%. In the note business, you're raising it all, right? You're raising 100%. So you get buying power, right, by being in a note fund. You also can tap into professional management and experience, hopefully, where they have the sourcing, right? They have better sources lined up maybe than you could get on your own, especially if you're a smaller note buyer. They also have a back office typically where they have some kind of support system in place to manage the fund and do it compliantly, and to be able to do their due diligence on the assets that the fund is buying, right? So that could be an advantage to a smaller investor who doesn't have a lot of money to do a ton of due diligence, for example. I remember one time selling notes to someone, and they're like, well, I don't even have the money to send a demand letter, like on the non-performing side. I'm like, what would possess you to buy notes if you don't have the money to do any legal work, especially in non-performing note world, right? You absolutely need reserves and some money to perform legal work, right? So, but people try to do crazy things. It's just like not having reserves to do the real estate business, right? And if you think about it, if you have money for if the roof goes or the heater goes, I strongly recommend reserves, whether you're investing in real estate or notes, right? You want to have money for repairs in the real estate world, and with notes, you definitely want to have money set aside for legal if you did need that, right? But there could be a lot less due diligence required of you as an individual, if you're investing in a note fund. You also get anonymity, right? So no one like if Dave, is the investor in a fund, nobody knows that I'm in that fund, right? It's private, right? So no one knows I'm the investor in the note fund necessarily, which is different with a note. With a note, you definitely, you're going to show that you're the owner. It's been recorded that, you're the owner of that note, whether it's your entity or whatever. So, and you also get diversification in a note fund. So I always use the analogy, if one note goes bad and you only own one note, it's 100% default rate, right? And if you own 10 notes and one note goes bad, it's a 10% default rate. And that's the beauty of being in a note fund. You have a lot of diversification, you own a lot of notes, and that's the part that's cool about it. If you lost one note or had trouble with one note, it's not the end of the world usually. And I did mention less liability, which is pretty critical. Being able to spread that risk amongst many assets, which is, I think, is one of the biggest advantages of fund investing. But for a note buyer, the biggest disadvantage, or for an investor, the biggest disadvantage might be a lack of control. So you don't have control when you're in a note fund. That would probably be the biggest disadvantage I could think of. But so, I don't know. Let me see. Do I have any questions out here? Somebody's saying they need a nice advantage. Trying to check out some questions here if I can. I'm not seeing any on this one. Let me see over here. Here we go. It's hard to see. Let me see. Some John from Jackson, Mississippi. I actually have somebody from Saudi Arabia. Wow. That's the cool thing about being on Facebook Live. You can talk to people from all over. South Dakota, San Diego. So yeah, it's great you guys are chiming in. Like I said, if you have any questions, comments, feel free to share. Feel free to give me a like, little love. And if you're just joining us right now, we're actually talking about which is better, investing in an actual note or investing in a note fund. And we just went through some of the advantages and disadvantages of investing in the actual fund. And now I wanted to talk a little bit about, actually investing in the passive notes themselves, right? So by investing in an actual reperforming note or a performing note right out of the gate, it gives an investor, greater control, right? You own it, you can touch it, you can feel it. You may have that placed with a servicer. So you're in greater control. The only downside is if something happens with the borrower when it comes to receiving the payments, you're also at their mercy, right? So it's a dual-edged sword. And some notes are sold with warranties and reps. I know we warranty our reperforming notes, which is a nice thing. Not everybody does that, by the way. But then again, they do have collateral a lot of times, and a lot of reperforming notes are placed with a servicer, which I use the analogy. A servicer is similar to property management for a note, and a lot of servicers will do, the accounting. They'll do foreclosure work for you. They'll also do other auxiliary services if you need them, property preservation, all kinds of things that servicers can assist with that are beneficial to note investors and note buyers. So with note investing, I think of some of the advantages and disadvantages. Definitely access, right? And by that I mean almost anyone can buy a note, right? Or anyone can, originating a note's a little bit different. But if it's a commercial note, almost anybody can originate a commercial note. Owner-occupied notes is a little different, varies from state to state, those types of things. But almost anyone can invest in a note, which is pretty cool about it. So you don't have to be high net worth. It's not a super high bar to entry to get started in the note business. And I know, I've mentioned before, there's sites like Lending Club. You can invest in notes with $20, $25, right? So it doesn't take a lot of money to get started in the note business. You can do it pretty inexpensively. And when you invest in notes, I did mention control. If you're the owner of the note and something goes wrong, you can jump in and contact the homeowner, whether it's through your servicer or your attorney, whatever, and you can try to do something to turn that deal around, right? You can also possibly get a higher yield, and that's one of the reasons people say, well, which is better? Is it better to be in a fund? Is it better to own a note? And the reason I say I don't know, I'm not that smart, is because you never know what you're going to make on a note until you exit, right? It's just like a real estate deal, right? You never really know what you're making till you exit the real estate deal. You can look back over history and say, oh, this is how much rent I collected, this is how many vacancies I had, this is how many turnovers I had, this is what I really made, not what I was supposed to make, right? Well, it's the same way with a note, right? Just because a note has the monthly payment and the interest rate and the amount and all that, doesn't mean I'm always going to collect 100% of every note, right? So, but you can possibly get a higher yield when you own the note than being in a note fund, because if you bought that note at a discount and the borrower cashes you out early, whether they refinance or they sell the property, and they cash you out early for some reason, your yield will go up dramatically, and it'll be dramatically higher than the interest rate on the face value of the note, right? So, there's a potential there for what we call it upside potential, right? So that upside potential is pretty cool when you get cashed out early, which can dramatically increase your yield, right? So it's a good thing, right? And the average borrower in the U.S. only keeps a mortgage 5 to 7 years. So there's a pretty high probability that you will get cashed out on some of the notes you own. And if you think about it, banks figured that out a long time ago. If they have, if you go get a mortgage in the United States, a lot of them are a 30-year mortgage, for example. And when you look at that amortization schedule, the beginning part of that amortization schedule is all interest, very little principal being paid back to the bank. Well, think of the advantage the bank has in that scenario when they know statistically the average person's only going to stay in a house 5 to 7 years, or stay in that loan 5 to 7 years. It's kind of like they have the system rigged a little bit, so to speak, where they kind of know they're making all interest, very little principal payback, and that's one of the reasons banks do very well, right? Also, another advantage to being a note buyer is you have collateral, right? It's an asset-backed investment. Plus, I think with mortgages, it's a little bit different than tenants in the sense that the borrower has, a vested interest in the property. They're the owner, right? It's a little different. There's, I call it an owner mindset. I'm not saying it's always different than a tenant. I mean, there's great tenants, but what they tend to have more of a vested interest. Let's put it that way, and it's their home. It's definitely a more passive way to invest in real estate as opposed to owning property, although there is that possibility that someday you may end up owning a property by owning the actual note mortgage, right? So, and then probably last is it's a secured asset, right? It's tied to collateral. There are a lot of notes that don't have that feature, right? It's unsecured debt, like a credit card or medical or student loan debt. It's not really secured to anything, although auto debt is, right? If you look at auto debt, you're secured by the automobile, right? That's why they repossess cars, right? But, and then also, I mentioned servicing, right? One thing I didn't mention about the servicing is that they'll actually perform a lot of your accounting, and they'll collect the payments, send late notices, and typically they'll ACH the payment over to you. So it is pretty passive to own performing or reperforming notes and mortgages. So it is a pretty passive way to invest in, a real estate backed asset. And it's one of the reasons I do enjoy the note business so much. And I do like real estate as well because I get tax advantages. So I didn't bring this up. This is not an either or thing. Although people like to make it that way. They like to make it like dual investments or something. One's better than the other. No, they're just different, and they're both good, and I love them both. So let's clear that up. Let's clear the air right there. But there's just different advantages and disadvantages to different investment vehicles. I like multiple investment vehicles. That's what I like the most, right? So hopefully you'll see it that way. Probably you definitely have an increased level of responsibility. You have to make sure that anybody that's working for you is compliant, whether you someone dealing with the borrower, whether it's the servicer you hire or the attorney you hire. Like, for example, we audit our law firms, right? So make sure that they are compliant. There's definitely less anonymity. I did point that out because your name would show on the county courthouse that you own that note and mortgage, your entity or whatever, because that assignment is recorded. And it's also required to be announced to the homeowner when a RESPA letter is sent, that type of thing. So, I invest in multiple commercial real estate funds and note funds, own many notes, and I don't know that I would put all of my capital into any one of these investment vehicles. I prefer to diversify between them all, right? And you got to keep in mind they all have different timelines too, right? So I know there's short-term ones. There's funds and notes that last 6 and 12 months, for example, and then there's ones that last 2 and 3 years, and then there's multifamily funds that last 5, 7, 10 years, right? So there's all kinds of different timelines involved, different amounts, different minimum investments. So a lot of that can dictate how and when and what types of vehicles you choose to invest in. And like you might be in a 3 or 5 year fund versus a 20 or 30-year note, right? So it's tough to tell which is better, because a lot of times you're rolling these preferred returns back into another investment vehicle, or you're rolling the note and mortgage payments into another investment as well. So you got to keep all that in mind if you're trying to keep your money moving and keep your money invested. So hopefully you're enjoying some of what we're talking about today, which is better, passive note investing or fund investing. And I actually cover a lot of that in my latest book, Real Estate Note Investing. I think it's chapter 17. We talk about sources of capital and getting started in notes, and we do cover this actual topic in the book. And if you haven't had a chance to pick it up, you can get 20% off by using the code LIVE Note Investing. If you go to BiggerPockets.com/note investing, you can actually get 20% off. And you also get some bonuses, right? There's an ebook called Stay Safe. There's a Brandon Turner video with me and my partner Bob. Actually, we go out to a couple servicing websites and look at a couple different notes. We look at performing notes, non-performing notes, first mortgages, second mortgages, and we actually walk Brandon through some of the things we look for, to watch out for. And also have an audio in that bonus material called Avoid Investing Mistakes with Mary Hart. So some really good stuff, really good bonus materials. If you haven't had a chance to pick it up, by all means, try to grab it. And definitely seeing some folks here from Birmingham, Alabama. How you doing? And now it's great to see all you guys from all over. We have folks from Nebraska. So like I was saying earlier, if you have any further note questions, that type of thing, by all means, join us on our next Note Investor Q&A call. We're going to cover compliance in the very beginning of that. That actually starts on, it's November 19th at 8 p.m. Eastern Time. If you want to register, you can go to my website, pprnoteco.com. You can also sign up for we have a weekly email newsletter, an e-zine. You can sign up for that if you want to receive a performing note every week in your inbox. And that's always fun, right? You can analyze those deals, see if that works for you. Our performing notes do come with a warranty. Our warranty is, It's purchase price minus payments received is our warranty. So if for some reason it went non-performing, we would buy that asset back. Not too many folks do that. And we also have a couple different note funds. We have a longer-term note fund and a short-term note fund called Reliant Liquidity Fund. If anybody's interested in a short-term fund that pays a nice yield, and you can find out about that on pprnoteco.com as well. Little shameless plug there. But the other thing is, so like I said, by all means, check us out on the next call. We do have our next Facebook Live will be on November 5th, which I think is a week from now. And we're going to be talking about how to buy a house with no money using notes. So everybody kind of likes how to buy a house with no money using notes. I mean, that's definitely one of my favorite topics. So hopefully you enjoyed what we talked about today. Didn't get to answer too many questions. I don't see many on here that I can see. But by all means, I will answer these questions. Once I get off the Facebook Live, I will definitely make sure I answer you if I didn't get a chance to already. And hopefully you can give me some likes and some shares. And by all means, I love the comments and reviews and that type of thing. If there's anything that you guys want me to cover on future Facebook Lives, by all means, let me know. But I do have some interesting topics coming up, so hopefully you'll continue to join me on future Facebook Lives. So, hey guys, thanks for joining me today. Hopefully you enjoyed some of what we covered, and good luck out there. Happy hunting, and happy Halloween. That's coming up too. So good luck, guys, with your note investing. Take care.